Joining in with his expert views is Madan Sabnavis, Chief Economist at CARE Ratings on the show. Well, Madan, to start off with, the overall situation with Iran has certainly put the overall macroeconomic fundamentals of the Indian economy in a better position with respect to the balance of payments situation. How do you see this boding for the Indian economy in the longer term?
So on the whole, I think it's a very positive impact as far as India's balance of payments are concerned, because having a stable oil price is one of the prerequisites for having a strong current account deficit, which will also finally get reflected in a strong balance of payments. But I think most of these factors work more in the short term rather than the long term, because it's going to be back to business as usual maybe after a couple of days. And because these kind of issues keep pressing, coming in and going out at the various points of time. And while the specific impact will of course be for a shorter period of time, I think we'll have to look at overall politics of the oil economy to take any kind of a long-term view about whether it's really going to improve the balance of payments substantially or not. So as of now, I think it will suffice to say that any kind of a negative impact has really been ruled out, and it could be more of the case of the other fundamentals which will be driving the external economy from now onwards.
The immediate cuts, though, Madan, if they do come about, would have a bit of a benefit on the fiscal deficit and the imported component of inflation. My question to you really is, do policymakers start taking that into account? Because that might have a favorable impact in the quarter of Jan to March, if it indeed does go down further.
Yeah, it depends upon how much it will be going down and what's going to be the quantum of the impact in terms of the subsidy bill which the government is putting right now. Because presently we should remember one thing is that there is still quite a bit of subsidy which the government is offering on certain petroleum products. And I think that's where the difference is really going to come about. Because we're not really talking in terms of compressing the fiscal deficit any further, only in terms of any kind of excesses in terms of the fiscal deficit or the subsidy bill in particular being exceeded. I think that's something which is going to come under control. In terms of inflation, I think there will be probably a very marginal impact on inflation, but definitely it will be more on the positive side, because any kind of reduction in the international price of crude would definitely have a positive impact on all the market-oriented prices of petroleum products.
Madan, what's your view on where the rupee is headed now?
I think the rupee will continue to remain in this kind of a position. I think 62 to 64 is the kind of range which we're looking at, because we are seeing that there are specific factors like what happens, what the Federal Reserve could do or may not do, or when they will do, which is really impacting the rupee at certain points of time. And the reason why we're talking of this particular range is that based on the fact that we have our fundamentals which are improving in terms of the trade balance, we've also seen a substantial amount of NRI funds, the FCNR deposit funds which have been coming in through the swap window. Though I think there's a big question mark, because we're really talking of something like over $20 billion coming in, and if you really see what's been the accretion to our foreign exchange reserves between September and the last week, I think, for which we have information, our forex reserves have actually gone up around $10 billion. So I'm not quite sure about whether this 22 billion which we're talking of is new funds which are coming in, or this any kind of swapping which is taking place within the NRI deposits. So based on the fundamentals, I think we are probably in the region of around 62, but I think there will be a sentiment of the market forces which would be coming into play once we get to know about any kind of uncertainties about the Federal Reserve's program. Because while logically one could take a view that until January, February, it's unlikely that the Federal Reserve will go in for tapering, because that's when the issues of the debt ceiling and the shutdown will be revisited. And that's a point of time when the Federal Reserve will have certain kind of confidence about whether the US government will be cutting back on its expenditure, which in turn will be affecting the growth prospects or not. But I think the market is going to be fairly whimsical, and I think any kind of news coming in is going to be on the tapering front, is definitely going to make it move. So 62 to 64 is the kind of range which we're looking at.
Just wondering if your conversations with your global peers as well would indicate that after what's happened in China in terms of reforms, are people talking about structurally there being chances of more fund flows going into that region as opposed to the other emerging markets including India?
No, I think that if you're looking at India, India as a market is quite special as far as foreign investors are concerned. And I think because we're really looking at the kind of excess capacity which is there, the potential which is there, which has not really been leveraged for whatever reasons we're talking about, I think India definitely holds a lot of promise. So I think the kind of funds which you're talking of coming to India, it's not a case of them saying, are they looking also at alternative markets to India, like is it going to be India or China? It's a case of saying that both these two economies are the ones which hold promise. So I think that's where the funds are going to move. So I think the decision will be more on whether you go back to the developed countries or whether you look at emerging markets. But I think India is a fairly special market among the group of emerging countries, and therefore I don't see any kind of substitution taking place between India and the other emerging markets. There would be, of course, substitution between the developed countries and the emerging markets, including India. But within the group of emerging markets, I think we still do probably have a fairly comfortable position.
Madan, when we look at the overall economic growth for India, it's virtually halved in the last 2 years to 5% in the last fiscal year. That was the lowest in a decade. The last quarter GDP growth somewhat improved on account of the manufacturing uptick. Do you think that for the coming year, what we're likely to see will be a worse print when it comes to GDP?
We're looking at GDP growth being almost at the same level as last year. So specifically, we're looking at a number of 4.9%. So that will just about mean that we're maintaining it. We can call it stagnation, no real impetus. Because what we're looking at now is that there's been a fair amount of stagnation in the first quarter of the year. And maybe even for the second quarter, we're looking at a number of something like 4.8%, which is not really a very critical period because there's not much activity in terms of both agriculture or industry. So I think the critical parts will, of course, be the third and fourth quarters, which are the time when typically spending picks up, consumption picks up, or should be picking up. So I think Q3 will be holding the clue whether India would be able to retain this position of 5% growth or not. Because in terms of agriculture, I think we're all fairly gung-ho about agriculture and the kind of growth coming there. And but it should actually lead to the positive linkages with other sectors of the economy, which we haven't really seen so far. But of course, I think October is the time when the Kharif harvest starts. So if at all there's going to be a revival in the prospects for industry, it should be more visible during this particular point of time.
Saying that even if the number is not the 4.8 but a 4.5 or even lower than that, you would discount it because Q2 is not really the busy season and the more important numbers will be Q3?
Yeah, absolutely, Neeraj. I would be discounting it because whatever we are seeing happening in this particular quarter, we should remember that we have the monsoon, so there's nothing much which takes place on the infrastructure side. We don't have any of the festivals or your harvest money coming in. Probably comes towards the end of September, but will not really get captured in these numbers. So therefore, there's more kind of a residual agricultural growth, residual kind of growth which we're seeing in the infrastructure space, and even in terms of industry, no direct demand coming in from the households. So therefore, I would not be giving too much of weightage to it. But definitely, if it comes to something like 4.4 or anything similar to what was there in the first quarter, one would have to, of course, revise the assumptions about what could possibly happen in Q3. So that would definitely be something to look out for. But presently, we are not definitely looking at a number of below 4.5%. Maybe 4.6, 4.7 would be the worst case scenario.
And, you know, it's not surprising really given the way things have shaped up with the government that most of the private sector's investment plans have been kept on hold. How big a trigger do you think will the overall elections be in terms of reviving the overall capex cycle as well as when it comes to the liquidity flows?
Yeah, actually, when you're talking of the capex cycle, I think I would sort of separate it from the elections because I think the elections are going to take place in the next financial year, and depending upon whichever way industry looks at about which kind of a coalition government is going to be positive for them, I think that's going to be seen more in the next financial year. But in terms of investment cycle, which you're talking of in the current financial year, I think a lot will depend upon all those investment proposals which the finance minister has been talking about, which he says have been cleared, something like 3.8 lakh crores or so. Now, how much of that is really going to get converted into actual investment? I think that's the big question mark here today. And once again, there is the conjecture that it could happen in the Q3 and Q4. Though, to be honest, I don't think we have seen too much of progress taking place out here. And I think that's partly on account of the increasing interest rate cycle which we're seeing right now. And even today, we're not quite sure whether the RBI will be retaining interest rates at what they were at in the last policy, or whether there could be another 25 basis point hike in the repo rate. So I think investors are, of course, looking in terms of what's going to happen to interest rates before they take a decision. Because we must remember that there is still excess capacity as far as Indian industry is concerned. And unless there is a resurgence in demand, there may not be a kind of a pressing need to go in for further investment, given the fact that interest rates are high. Now, in terms of the elections, I think towards the end of the year, there would definitely be a positive impact on specific industries, especially things like automobiles or your chemical industries, which paper industries. I think these are the kind of products which would become fast moving as the tempo gears up for the elections. So maybe in Q4 there could be some kind of positive for overall industrial production.